Hi guys, welcome back to our course Trading Option for Beginners at Udemy. In last lecture, if you remember, we talked about the option price or option premium, and we already talked that far out of the money calls are located here and far out of the money put options located below the chart, and we already know what the option price or option premium is. And now let's see how option price behave during the time of far out of the money option. So this is far out of the money option price curve. As we know, if the price never reached the strike level of the option, then this option expire worthless or zero. So this chart represents how the price of the option goes during the time, how it behaved during the time. So the lower scale shows the day before expiration, and the vertical line shows the option value. So let's imagine like this is $100. For the far out of the money option that cost $100, and if it's sold 4 months before expiration, for the first month it will lose this amount of value, and for the second month it will lose a higher value, and for the third month, so 60 days before expiration, it will lose this amount. And according to this chart, the most time decay happens during the last 30 days of an option. We need to remember that. And also we need to remember that the further out of time we sell, the less amount we can receive as a time decay for the sold option. So the option lifetime is limited by its expiration, and if the price never reached the strike level of an option, then option is going to equal to zero. This is what we need to remember. And at this point, we go into an idea what is the best, to sell far out of the money options or to buy them. And I got some conclusions for you. So according to exchanges, about 70% of all sold options expire worthless. It means that price never reached their levels. This is good for option sellers, because they sell an option for a specific amount, and then by the expiration the option costs zero, and that makes the whole price premium goes as a profit to the pocket of option seller. So when you buy an option, you have to pay its premium for its seller, or when you sell an option, then you receive this premium. An option has a limited lifetime that we already talked about. It's an expiration date. And when you sell an option, you receive a premium on your account, and sum of all premiums from all sold options will be yours after options expire. So this brings us to the very important idea that concerning far out of the money options, far out of the money calls or far out of the money puts, it's better to sell them to generate the profit and collect it every month. When you know premium, also you know the trade length, like 30 days or 60 days, you may choose your return on investment, and you know what returns you're gonna receive in 1 month or in 2 months or in 3 months. This is very important, and it's not possible at any other type of tradings. When you purchase a stock or forex asset, you never know what is gonna be your profit in a month. But definitely you may forecast your profits when you sell the options. So on this point, I would like to say that selling far out of the money options is profitable business.